Hey there, everyone. Happy Tuesday, February 18th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you not from Redmond, Washington, but as you can see from the very obvious hotel room background, a hotel today in Las Vegas, Nevada. We're in town here for the Las Vegas Money Show. It's been a fantastic event so far, made even more fantastic by the fact that a number of you, my viewers, have said hello at the event. And I can't tell you how much that means to me and how much I appreciate you swinging by and introducing yourself. Had 4 podcast interviews recorded today. I'll be getting those out over the next week or so, but had some really good conversations with Lindsay Bell, Christina Hooper. Who else did I sit down with? Keith Fitzgerald. Really fun conversations. Jordan Kimmel was the last one. 4 really fantastic guests. We got into a lot of different topics, from mindsets to risk management to the Fed to small caps versus large caps, tariffs, so many other topics. My mind is swimming, and that's why I'm a little late with the broadcast today. I had to get all those interviews done. So can't wait to share some of those conversations with you, those of you that are not here at the Money Show. And thanks for being patient as I go live a little later than normal, but that is what we need to do on some of these trips. Overall, I was able to follow the markets kind of off and on through the course of the trading day, but really focused here a little bit over the last 30 minutes, digging into some of the charts, finding some of the key ones to share with you. So let's get right to the market recap. I do see questions. If there are questions that come in, I know it's a little later than normal, but if questions do come in, I'll try to take a question or two before the end of the broadcast. Otherwise, we will wrap it up here and we will get back personally to the Vegas life here for the evening. All right, looking at the major averages here today, you can see essentially a flat day for the Dow. Now, the Dow was down quite a bit around 2:30 Eastern. Big surge to the upside. It pushed the Dow essentially just slightly above Friday's close. Monday, of course, yesterday, markets closed for the President's Day holiday. So this is the first trading day of the week. The S&P 500, a little bit better, actually finished positive about 0.25%. All of those gains came essentially in the last 10 minutes of trading. So there was a big rally going into the close, which are making these numbers look a little better than they looked at 3:50 p.m. Eastern time. Mid caps and small caps in the green as well. You can see the S&P 400 mid cap index, the best performer of the bunch, up 0.9%. The Nasdaq 100 up about 0.25%, essentially the same as the S&P 500. The VIX moving higher. We were on a 14 handle after Friday's session. So we're talking mid-teens on the VIX. We're talking low volatility, low fear, low uncertainty. Market telling you conditions are okay. The VIX actually opened quite a bit higher. It did trade slightly above the 16 level earlier in the day, and by the close, as the market surged higher going into the close, the VIX did drift lower to finish around 1540. And I would say overall, we are still in a low volatility environment. Markets are telling you there's not much to be worried about. You know, what I'm seeing is, I guess, questions about the sustainability of gains that we've seen from what we've seen so far in 2024 into 2025. Again, not to steal the thunder of some of my podcast interviews, but some of my guests that I interviewed today, pretty constructive about market conditions. Others a little more measured and address some of the concerns that I think we'll see, some of the more macro-focused strategists. But I would say those that have a technical analysis component focusing on trends were overwhelmingly pretty constructive about market conditions right about now. All right, looking at the interest rate and the fixed income environment, you can see that bonds sold off today. While stocks rallied, bonds sold off. Rates actually drifted higher through the course of the day today. The 10-year yield finished just above 4.54, we'll call it. The long bond yield just below 4.8%. And the 5-year point just below 4.4%. I did grab the chart of the TLT, looking at bond prices. As you will see it from a technical perspective, incredibly orderly downtrend. And over the last couple of weeks, we've seen a rally up to the upper end of a big downtrend channel. And now this week, appearing to be rotating back toward the midpoint of that downtrend channel. I did ask a number of my podcast guests today about the dollar. I would say general takeaways from my conversations today. Having some non-US exposure was a pretty common reference that some of my guests mentioned based on the performance of non-US markets, things like Germany making new highs, as we highlighted on this show last week, looking at the EWG. For today, not much of a change. The dollar slightly higher from Friday's close. Looking at the commodity space, you can see gold and silver continuing their incredible runs here. Gold outperforming the S&P and the Nasdaq year to date in 2025, and that appears to be continuing with the S&P essentially up slightly, but gold up almost 2%. Silver prices, the SLV was up over 2%. Besides copper that went down today, the other parts of the commodity space doing just fine. And the two top performing sectors, by the way, as we'll mention, as we'll show you here in a moment, energy and materials, two of the, arguably the two most commodity related sectors. Bitcoin chopped around quite a bit this weekend, did spend much of yesterday trading around that 96,000 level. Today, currently around 95,500. That's not much of a change from yesterday's close. We're actually just opening the new 24-hour sessions. That's a bit of a misleading percent change because the markets roll over. I think that's at 5 p.m. Pacific time. I don't remember, to be honest with you. But basically, there's a 24-hour period for cryptocurrency. So there's a close, quote unquote, that's locked in based on the market convention. Ether prices up slightly here. You can see a gentle uptrend in Ethereum during the equity trading session, currently just above 2670. Kind of mixed results at this point for the rest of the cryptocurrency space. But generally, you can see they traded higher during the equity trading session. All right, let's look at the 11 S&P sectors, and we can see that from a sector perspective, pretty decent day, right? While the S&P was up slightly, the Nasdaq up slightly, most of the 11 S&P sectors were actually in the green. As a matter of fact, 8 of the 11 finished in the positive territory today. Energy and materials, your top two performers, as we mentioned, those are very commodity-oriented sectors. Energy, number one, up 1.4%. The XLB, which is materials, was number two, up 1.3%. Utilities, I guess the new growth sector of the current era, up 0.9%. Just followed closely after by technology, about the same. The three S&P sectors in the red: communication services down about 0.5%, consumer discretionary down 0.3%, healthcare down 0.2%. You know, looking at breadth conditions, we can see that it was a pretty decent up day, but it really depends on where you're looking, right? Look at the Nasdaq Composite, was essentially a coin flip between stocks up or down. You look at the S&P 500, 72% of the S&P members up today, 27% down. So for the S&P large cap, mid cap, and small cap indexes, pretty decent update. One of the charts I grabbed was looking at the S&P members above their 50 and 200-day moving averages. You will note that the percent of stocks above the 50-day moving average starting to rotate slightly higher here from last week into this week. You know, we didn't have a live show on Friday. We had an all mailbag episode. And again, thank you all, those of you that have been sending in questions either on our YouTube channel or during the live broadcast. Really appreciate the questions you guys are doing. It makes this show more interactive and more interesting, I think, for all of us. And I really appreciate it. So Friday's episode was a lot of fun. And if you missed that, please go back and review some of the great questions some of your fellow viewers have sent in. It's really helped us to address some really thoughtful questions about the current market environment. But since we did not have a live show on Friday, just wanted to point out that our market trend model is pretty much bullish on all time frames. That's been the case for most of the last 12 months for the S&P 500, which is our main market trend model. The short-term model has turned slightly negative a handful of times over the last 12 months, but overall, my analysis of market trends is telling me long and strong, be focused more on capital appreciation or capital growth than capital preservation, because things are good. Trends are positive. Looking at the Magnificent Seven and friends, though, noticeable to me at least that while the S&P is up, while most stocks in the S&P were up, while most sectors in the S&P were up, most of the Magnificent Seven friends were actually down today. NVIDIA and Microsoft finishing slightly higher. Apple essentially flat for the day, and everything else in this bucket of leading growth names were down. Leading the way lower, Meta, which it turns out can actually go down. It's been up most days here in 2025, but Meta, and again, Meta's still off of a new all-time high on Friday, so let's not get too excited, but did have a downward move, almost 3% lower today. Netflix, which again has been one of the better performing FANG stocks here, coming off of a new all-time high on Friday, giving back some of those gains, pushing lower. So those are, arguably at this point, I think you have to think of those as counter trend moves, just pullbacks within an uptrend. Arguably a very healthy thing for a name like Meta or Netflix to do is to digest some of those gains, as we would call it, a digestion move. You've had the big meal, now you have a bit of a digestion, pull back a little bit, often makes a higher low, often makes a new uptrend phase. So overall, worth noting some of those leading names in 2025 out of this basket of stocks on the downside. All right, let's look at the market carpet, which is again a heat map style visualization. I'm a big fan of this sort of approach because it helps you really assess the overall environment, but then focus on actionable particular ideas, looking at one day as a snapshot. But again, I love doing this every day. What stands out to me looking at the market carpet, again, ignore Meta and T-Mobile and Netflix and Broadcom, which had kind of rough days today. Overall, pretty decent day. I mean, look at all the green boxes that you see here, from financials in the lower left corner to some of the defensive sectors like real estate and utilities, to energy and materials, to the commodity-oriented sectors, to industrials in the upper right corner, even healthcare. I mean, some decent up days across the board here. And some of the charts like Nike within consumer discretionary, arguably not some of the better charts. I mean, if you're asking me what are some of the better consumer names in the last 6 months, Nike definitely not one of the names that comes to mind, but today up over 6%. So you have some of these stocks that have not done particularly well, actually bouncing off of support. Nike arguably maybe making a big double bottoming pattern. That's what it looks like on the weekly chart, at least for now. That's assuming that kind of 70 level holds, which is the floor from last summer, and certainly the floor year to date that we've experienced so far. As I mentioned, down days for some of those leading names. And what's striking here today is Meta and Netflix, arguably the two strongest out of the Magnificent Seven stocks, leading the way lower today. Also within communication services, T-Mobile. Now, while T-Mobile, I understand, is not one of the Magnificent Seven names, it has been a fairly magnificent chart here in the early days of 2025. December was pretty rough for T-Mobile. We flipped the calendar to January, and all of a sudden it just continues that uptrend that we experienced going into Thanksgiving, returning the uptrend phase, pushing to new highs. And overall today, again, some of those leading names pulling back a bit. I'm also noticing one of the conversations I had today, I think this was with Christina Hooper of Invesco, although some of those conversations have blended together a little bit. I was doing a lot of interviewing and a lot of talking today, but I think it was Christina or it was Lindsay Bell when I interviewed her. We were talking about technology and how, maybe what we're seeing right now in terms of leadership rotation is less from growth into value, but more growth into other growth, right? More of the Mag 7 kind of names into other areas of the market. So today, as I'm debriefing on the market action and I'm seeing these strong returns, again, not in Apple or Nvidia and Microsoft or Broadcom, but in other names, Oracle, arguably still one of the bigger names within technology, Arista, Palo Alto, Micron, Intel, Lam Research, all having strong updates. Microchip, MCHP, one of the semiconductor names that's been struggling quite a bit, having a bit of a rally. I think that's an emerging theme to pay attention to, right? When names like the Magnificent Seven have been so good for so long, and then they start to pull back a bit, the question is, where do those assets go to, right? If people are selling out a bit on those names, where are they going? We've seen at times sectors like utilities. We've seen at times other value-oriented sectors like financials. Maybe we're seeing other growth names, just not the biggest ones, right? Maybe it's other areas of technology that have been lagging a bit. Certainly something to think about. And again, I'll share that interview with you here very soon. All right, we're going to finish off today's show going through the charts, but I do want to let you know, by the way, we do have a free webcast coming up next week, and we actually just turned on the signups for that earlier today. I'll be doing a presentation next Wednesday, February 26, 1 p.m. Eastern, 10 a.m. Pacific, called Finding Value, the Great Rotation of 2025. We were going to play. We're going to play a little bit on this theme that we just talked about. If the Magnificent Seven stocks, and again, Meta and Netflix down today, but for the most part, those have been the outliers in how strong they have remained. Other areas of the market have been a little weaker. And I'm wondering where that rotation may be. Do we see further rotation away from charts like Microsoft, charts like Alphabet, charts like Amazon that are continuing to pull back here in the early days of 2025? Where are we seeing stronger rotations? We're going to focus on which areas of the market have been showing the most strength in the early days of 2025. Think about some of the macro conditions, and from a technical perspective, where we're seeing emerging strength. We'll talk about rotations. We'll talk about leadership themes. We'll talk about large caps versus small caps, growth versus value, and all those other things that can help you make sense of the markets here in February 2025. You can sign up for that free event by going to marketmisbehavior.com/value, or just scan the QR code that you see on the blue shirt, which it turns out I'm actually wearing right now as I'm looking at that image. My assistant managed to grab the actual shirt I'm wearing today. So I hope you can join me for that free event coming up next Wednesday, a week from tomorrow. And again, you can sign up at marketmisbehavior.com/value. All right, let's finish off looking at some charts here. The S&P 500 remaining above 6,100 now for 3 straight closes. We closed above that 6,100 level on Thursday's session. Friday, again, going into the long holiday weekend, lighter volume, not much of a change in terms of trend. Today, I think a very important late hour surge to push the S&P 500 to a new closing high. S&P closing just below 6130. We'll call it 6129 and change, but that remains above that 6100 level. Maybe that's the new, at least short-term floor to pay attention to, right? When you have a big established level of resistance like 6100, we first reached that in early December. We finally closed above December, finally traded and traded right up to it with this bearish engulfing pattern earlier this month. On Thursday, we closed above it, and for now, holding that. So I think holding that 6,100 level pretty meaningful. If you would get any failure below 6,100, that 6,000 level, which is right at the 50-day moving average, kind of the immediate short-term level of support. For me, long-term, as long as we hold 58.50 on any choppy period, I think we're still in good shape. A break below 58.50, you will hear my tone certainly probably change, where we talk more about defensive positioning and capital preservation and all those things you want to think about when the markets are going down. They're not going down today. We're making a new all-time high yet again. Now, one of the concerns, and I did a show on Stock Charts TV that just was posted earlier this morning on my weekly show on Stock Charts TV, usually on Monday. Today, this week was a little different because of the holiday. We talked about what I call the 3 signs of the bear, and one of those bearish signs that I've often seen at major tops would be breadth not confirming new highs, and that's been the situation when you look at the percent of stocks above their 50-day, when you look at the percent of stocks above their 200-day, and honestly, a lot of other breadth indicators as well. One of the challenges to this market here in 2025 are the breadth indicators, which a strong breadth indicator is a great is a great signal confirming a strong market. We haven't had it. We've seen breadth conditions actually fairly weak. As a matter of fact, about a week ago, we've got 50-50, a coin flip of whether an S&P member is above or below its 50-day moving average. The first time we tested 6,100 on the S&P, that number was up around 70%. So a lot less stocks in primary uptrends, or at least relative to their 50-day moving averages. We're starting to see here in the last couple of days this indicator tick higher a little bit, and I would say that would be one of the most encouraging things I would look for in this particular environment. The markets have been going higher on weaker breadth conditions. Do the breadth indicators improve to the degree that you can say this is a broad advance going through February and maybe into March? So I think this chart may be a really important one to watch to see if more and more stocks regain their own 50-day moving average and push higher. So far, first trading day of the week, that's the trend that we're seeing. We've highlighted the technical trends in rates. And again, with any interview that I do here in recent months, I've always asked people about the Fed, about the interest rate environment, et cetera, et cetera. So it's certainly been top of mind for me as we think about the market conditions here early day in 2025. I would say for now, watch this downtrend in the TLT. We've been tracking this trend for quite some time. We've been tracking the trend in the 10-year Treasury yield generally going higher. And I would say overall, the TLT coming off of a high in September, making a significantly lower high in early December, and now making a lower high as well. And a trend line connects those levels just beautifully. What I love about a chart like the TLT is a trend line like this just really represents the trend well, right? You can see that we're testing the trend line resistance a number of times during this downtrend. In some ways, this is one of the easiest charts you're going to find because you just follow that trend line. And as long as we remain below trend line resistance, the primary trend in bonds is lower. At some point, price of the TLT will break above that trend line. And that is when you want to start to wake up and recognize, okay, bonds had been in a downtrend and now they're starting to be in a bit of an uptrend. For now, remains to be seen, but I would say at this point, we're still in a downtrend. Friday session, by the way, we did trade right up to that trend line again, but today rates going higher, bond prices going lower. So I would say still remains in a downtrend phase. Tell you one thing that is not making a downtrend phase happen right now is gold. Gold remains one of the strongest areas of the market, even with the S&P and the Nasdaq threatening new all-time highs and the S&P making new all-time highs today. Gold is even stronger. The GLD has outperformed the Qs and the S&P 500 so far year to date, first 6 weeks of 2025. That's after outperforming the major equity benchmarks through much of 2024. So the strength in gold remains, I think, a key area of focus. We've highlighted the strength in gold many, many times. In full disclosure, we do own the GLD in our own accounts. And the reason primarily is because of the fact that the price is going up. In general, I want to own things that are going up, and I want to not own things or be underweight things where the price or the trend is going down. Gold, general trend has been positive, making a new all-time high again today on the GLD. Now, what's interesting is gold stocks have generally been lagging behind the strength of gold. While gold itself, the GLD, if you can look at gold futures or spot gold prices, they've been remarkably strong in 2024, but gold stocks, not necessarily the case. And you can see the GDX, which is the VanEck Vectors Gold Miners ETF, Q4 was pretty rough. So, while gold actually remained quite strong, gold stocks actually gave back a lot of their gains in the fourth quarter. Also had a rough start to the year, by the way, with January and February being pretty painful. Now, in the early days of 2025, look at how that changed, right? The GDX was making a new 3-month low in the last trading week of the year last year. And all of a sudden we flipped the calendar and gold stocks resuming their uptrend phase that they were experiencing in Q3 of last year. The GDX not quite making a new all-time high above the October 24 peak, but certainly heading in the right direction. Now at the bottom, I'm showing you the relative performance of the GDX or gold stocks versus the GLD. So this is gold stocks versus gold. You can see that gold stocks have actually been outperforming gold in 2025 so far. Now that's something we talked about sort of toward the end of this end of last year into the beginning of this year, because gold was remaining so strong and gold stocks were lagging. The question was, do we get a catch-up trade with gold stocks starting to catch up to the strength in gold? Arguably, I think that's what we're very much seeing here. So I think gold stocks remain fairly constructive from a technical perspective. All right, we'll finish off looking at some individual names and individual charts. I'll take a question or two and we will be done. Caesars Entertainment, have to start here because I'm staying in a Caesars property as we speak. I'm at Paris, Las Vegas, also gone to the Horseshoe and some of the other Caesars properties during my brief visit to the Las Vegas here this week. Do want to highlight CZR along with some other gambling names have a nice bounce higher here in recent weeks. Caesars actually gapped higher on Thursday of last week, pushing the chart above the 200-day moving average. Friday and then today, we're sort of holding those gains. And when you have a chart like this that's been below the 200-day for so long, if you do get above the 200-day, you want to make sure that we hold it. That's what was so dangerous there in early November, is all of a sudden we were not holding that move above the 200-day. That really told us about further weakness was probably in store. And that's kind of what happened into the beginning of January. From there, we've once again regained the 200-day. I think resistance now becomes support. You watch that 200-day to see if we can hold it. For now, pretty impressive that we're breaking above there. Taking a position on a chart like this and using the 200-day, using that gap from last week as a natural kind of built-in stop. I don't have a problem with that particular approach. Not a trade that I'm making right now, but I would say I would get, from a technical perspective, I would say that makes quite a bit of sense. Now, compare Caesars to MGM, one of the big other big, obviously, gambling names here in Las Vegas. Gapped above the 200-day moving average on Thursday. Friday, a bit of a distribution candle. This wasn't really a painful candle pattern. It wasn't like a bearish engulfing pattern or anything like that, but it wasn't great, right? Because we had the gap higher on Thursday. Friday, we closed much below the open, but today we're actually closing back below the 200-day moving average. So I would say between the two, MGM and Caesars, MGM a lot more vulnerable than Caesars, which for now is holding the 200-day. It's not exactly a candle pattern that I'm familiar with, but if you think of Thursday as the move higher, you sort of mentally connect Friday's sell-off and today's sell-off, and you have a 3-bar pattern, which is kind of like a bearish engulfing pattern, just you're splitting day 2 into 2 separate trading sessions. So that's kind of how I would think of this, and I would say the failure to hold the 200-day is a problem. You'd want to see it bounce tomorrow, and if not, I would be avoiding a chart like this because you're now trading back immediately into that gap that was formed last week. Airlines, which have been struggling a bit here over the last couple of weeks, bouncing a bit today. American Airlines Group for now holding that Fibonacci support. We also highlighted the gap range from early December when we gapped higher there. So we've traded back within that gap. You can see the Fibonacci support around 15.25. For now, those are all holding, which I think is pretty constructive. Again, I would say the general movement in airlines have not been particularly strong. However, I'm always looking for potential areas of support. We're kind of right in the middle of that over the last couple of days. Today, actually pushing back outside of that gap range. I think if we can hold this support that we're highlighting on the chart from around 15 to 1570, I think that could be a pretty compelling area of support. That's coming after a bearish momentum divergence that we highlighted in January. SMCI, super microcomputer, which probably sounds familiar because it had an incredible run the first quarter of 2024 before trending lower through the rest of the year, essentially. But through the last 6 months, we've created what's called, probably a complex invert head and shoulders is what I would probably call this. But the neckline, however you want to call this, using the trend line from the October and December highs, just broken on Friday's session. Today, nice upside follow through. So anytime you have like a neckline and then a trend line break, my question would be, do you get follow through that next trading day? Today, Tuesday's session is the next trading day following Friday's breakout. Good news, we've continued the upward climb and eclipsed the 200-day moving average for the first time since July of last year. I think super microcomputer really, showing some strength here, potentially setting up for a retest of those previous highs. Certainly showing some strength recently. In terms of breakdowns of neckline support, I will highlight Chipotle. If you look at the low from late October, look at the lows in January, you can see today's session down about 4.5%. That puts this burrito maker below trendline resistance or trendline support, basically the neckline. This is a bit of a head and shoulders kind of pattern. Probably call this a complex head and shoulders. But if you look at the last couple weeks, we've been trading between price support from the October lows and moving average support. The 50 and 200-day moving average are right around that 58 to 59 level. Today, we're actually resolving to the downside. Instead of breaking above moving average resistance, maybe setting up a retest of the previous highs. This is breaking down. I think Chipotle is a vulnerable chart. I don't like the breakdown unless you get a nice counter trend bounce tomorrow. I would say that is a vulnerable chart. Intel showing some strength. And again, I'm remembering one of my conversations today. We talked about whether it was a leadership rotation, not just from growth to value, but maybe from previous leadership growth to other growth names. Intel comes to mind. Now, Intel has been what it was like the semiconductor that was not a part of the AI frenzy. It was considered a laggard in the AI frenzy that fueled so many of the gains in 2024 from other semiconductor stocks. But in the last week, Intel has started to really surge higher. Today's move continuing the strength that we saw on Thursday of last week. Friday was a bit of a pullback off of the 200-day moving average. Today, powering above the 200-day, powering above that November swing high. I think Intel, from a technical perspective, strong chart, and I'm eyeing those swing highs from July, which is up around the 36 level. Mid 30s would be a nice further gain beyond what we've seen so far. Final chart of the show, Western Dig. Again, I'm seeing some breakouts in different places. So again, you're seeing some breakdowns, some breakouts, quite a bit of movement in the equity space. And I would say Western Digital for now, kind of encouraging, getting above Fibonacci resistance. We look at the June 24 high to the August 24 low. I've been watching these Fibonacci retracement levels because we've had a lot of trade around those points. And the number of times we've attempted to get above that 61.8% level, you can see every one of those have failed. Now, most recently here in late November, it actually did hold it for about a week and a half before, again, failing there. We failed here with a very notable shooting star candle in mid-January. We traded up there about a week ago, and then today finally getting above 70, pushing above that Fibonacci level. You want to make sure that that holds. If not, it's not a great breakout. It's a failed breakout similar to what we experienced in the second half of last year. But if it can hold, I think that could be setting up for a further upside. For now, I like the breakout and the action in Western Digital. All right, let's take a question or two. Someone mentioned sound cutting off. I apologize. We're doing this from a hotel room. The connection seemed pretty stable, but you just never know when you're at a hotel with a bunch of other people trying to use their own connection. So I apologize if the audio has not been good for you. We'll see if I can clean that up as I post the replay. All right, NZC, thanks as always for watching. You've been a frequent watcher and I've often had some great questions. Hi, Dave. As an indicator, what differences do you find between Chaikin money flow and ADX? Oh, that's an interesting question. Those are actually two very different indicators, to be honest with you. And I'll show you what I mean. Let's see here. I'll pick a random name. We'll throw like Apple in here. We'll look at the Chaikin money flow. And also look at the ADX line. By the way, who was I talking to just recently about technical indicators? Actually, someone I am sponsoring for the CMT exams. When you get the CMT, to actually get the CMT designation, which I hold, and a couple thousand of my friends hold as well in the industry. I was sponsoring someone. When you want to actually get the CMT designation, you have to pass a bunch of exams. Then you have to become a member in the organization. The only way you become a formal member is by getting 3 other current members to approve you and to sign off, to review your work and sign off that what you're doing is legitimate. It's a great way to just make sure that the community is policing itself and holding ourselves to high standards of ethics and also understanding the body of knowledge. And he definitely did. I did approve him, and hopefully he gets his CMT here very soon. He's a financial advisor based in the Midwest. But one of the things we talked about was technical indicators, because we're talking about which technical indicators we used. When I was learning technical indicators like the ADX line, like DMI, RSI, MACD indicators, what I was told to do, I guess, by one of my mentors at Bloomberg, was to prove out every one of those indicators in Excel. So I basically had the raw data, the closing, open, high, low, close data on a stock, and I would have to show him the proved out calculations of those indicators. I hated it when I was doing it. I was cursing his name as I'm sitting there late at night in the Bloomberg offices trying to prove these things out. But now looking back 20 odd years ago doing that exercise, I'm so thankful that he made me do it, because it forced me to understand each of those indicators, how they're calculated, and being able to answer questions like this. I'm immediately going back to those Excel spreadsheets mentally where I had to prove out how they were different and how they were similar. And I will tell you, one of the things that you immediately learned was how similar certain indicators are, right? When you look at the charts and they look very similar, it's not surprising when you prove them out, because you find that your Excel spreadsheets are very similar. But you also find with 2 indicators like Chaikin money flow and ADX line they're actually very, very different. So that was a long-winded answer, but hopefully interesting to share with you that these are actually two very different indicators. I'm not surprised you're thinking they're similar because they look very similar, but Chaikin Money Flow is actually looking at volume, and it's looking at volume weighted by every day's trading. So instead of looking at a daily running total of volume, which is called a cumulative advanced decline line, right? If you're talking about the major averages, or just a cumulative volume measure, right? On balance volume looks at the daily volume reading and keeps a running total based on whether every day was an up or down close. Chaikin Money Flow does a little more sophisticated of a calculation, and it's basically a weighted measure of trend in volume. The ADX line was an indicator created by Wells Wilder. It was unveiled in his book, New Concepts in Technical Trading Systems. Is that right? Boy, I'm too tired to really remember the name of that book, but I think that's the book. It was a book by Wells Wilder where he actually showed out with an accounting ledger how he created these different indicators. ADX comes from the Directional Movement Index, DMI, and that indicator is looking at high prices and low prices and measuring trend. There's no volume component to it. It's just measuring trend. So you have one indicator measuring volume and directional volume. You have the other one measuring the strength of the trend, and really is volume agnostic, has nothing to do with volume. I would say that those two indicators, using them together, could be quite valuable. Using another indicator like RSI, which is looking at price momentum, totally different as well. The moral of the story is to say using different indicators with different calculations and then verifying the signals that you see from those very different indicators is a tried and true approach to technical analysis. The mistake I see a lot of people making is they use indicators that are too similar, and as a result, you're basically not doing much different, right? You're kind of confirming one another, but they're not really that different of indicators, so it's not really helpful. So that's why those two indicators are actually very, very different. They're looking at very different inputs, one measuring volume, the other one measuring the strength of the trend, and basically looking at the trend in the price as a way of defining that. I would say these are two very different indicators, and while they might line up sometimes, that's more of a coincidence, right? They're actually measuring very different things. Thoughtful question there. Thanks for asking about that particular set of technical indicators. Folks, we will call it a night here from Las Vegas. I want to thank you so much for being patient as I go live way after I normally do, but this is when I could actually fit it in the schedule here. I'm going to go back and do some Vegas things here responsibly, of course, with the remainder of the evening. But I want to thank you guys so much for tuning in. And again, thank you so much those of you that are in attendance here at the Money Show in Las Vegas and have taken some time to say hello. I really appreciate you doing so. I will be speaking, if you are at the Las Vegas Money Show, I'll be speaking tomorrow at 11 a.m. Pacific, doing the 4 deadly sins of investors. And we'll talk about 4 things that you probably have found yourself doing, the behavioral reasons why you do them, and some of the technical tools to address them in your own trading. So please make sure you attend that event and say hello if you do. For those of you not in Las Vegas, I wish you a fantastic evening. And remember, it is always a good time to own good charts. Have a great night, folks.